Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
All right. That may or may
Can you hear me?
Yes. Oh, there we go. Is that you, Mark?
It's another guy named Mark.
Oh, no.
No, it's me, Dorian.
Okay, great. All right, so we're off to a little bit of a late start, but I wanted to welcome everyone to this afternoon's webinar. Today's session will be hosted by Mark Sebastian, who has joined us right now, and he will be teaching us how to trade iron condors on ETF options. A little bit of background on Mark. He's a former market maker on both the Chicago Board Options Exchange and the American Stock Exchange. Along with his role directing the path of education for Option Pit, he also trades privately. He started the popular options blog, Option 911, which is now known as the Option Pit blog. So without further ado, I'm going to go ahead and turn it over to you, Mark.
Great. Well, you know why I changed from to Option 911. Katrina, was I got the stick of everybody calling the blog Option 911, and I made the decision that I did not want my blog associated with the World Trade Center. Just was kind of a strategic decision on my part.
I think Option Pit is a fine choice.
I think it was, definitely. So today is going to be a fun one. We're going to have a good time. I'm going to dig in. It's going to be really interactive, which I think you guys will like. So I'm going to be showing you not only. Let me switch my account. I'm going to open up a paper account here if you guys don't mind, as opposed to my live trading account. And then, so what I'm going to really be showing you is kind of a list of kind of what I'm looking for in an iron condor, how to build it, and some just general guidelines. I think it should be really a lot of fun today. So, and it's going to be interactive. It's not going to be a bunch of slides. We're actually going to walk through building and we can do it in a couple platforms if you like. You pick the platform and I'll build it. All right. So will the entire session be available for watching and recorded? My understanding is you guys record everything, right, Katrina?
Yep, the webinar will be available at ise.com/archives within a few days.
Wonderful. All right, so let me get some slides going. Show. Slide. And we'll begin. All right. I'm showing my screen yet?
Right now it looks like we are viewing your desktop. Yep.
All right. Now do you see a small child reading Trade VIX derivatives, or do you see?
Yes, we do.
That was actually hilarious. I got up to get my kid some food, and when I had come back, he was reading one of my option books. I was like, there's a boy cut from the red cloth. That's what I said to
Start
myself.
early.
Yeah. So. Although we hate that thing, we hate that word here, the boo, that book, because it's nice. So, all right, so today, what will you learn? All right, we're going to talk about what is delta neutral trading. All right, what is a delta neutral trade? What are some delta neutral trades? I'm going to show you examples of all of them. And then I'm going to talk about how to decide if an iron condor is a possibly decent trade. And then I'll talk about how to set up an iron condor with high odds. I'm going to try and give you some tips for improving your iron condor strategizing. All right. So, what is a delta neutral trade? A delta neutral trade is a setup in which, at onset, the trade has no directional bias. This does not mean the trade will not have a bias eventually. All right, simply at onset, the trader does not. All right, as the market moves, the trade develops a bias. This is actually one of the very major things that people screw up when they think about delta neutral trading. Just because a trade is delta neutral doesn't mean doesn't mean that it's not sensitive to price movement. All right. The interesting thing is delta neutral is sensitive to basically price movement in either direction, just not one direction. And that's really what differentiates it. All right. I like to put it this way. In the end, delta neutral is a trade on volatility instead of market direction. All right. Now, what is volatility? Guys, what if you're going to sum up volatility in a sentence? How would you guys sum it up? There's not a slide. So how would you guys sum it up? I see a couple of people that I know can answer.
We have a few people with responses in the chat window.
I see it. It's a fear indicator. I just see any audio. Something close to range, how quickly, and fair price. James, I like what he's got. He said something close to a range. That's actually right. Now, I didn't put a slide up, but we can actually, find it. Delta neutral really represents the expected move of basically anything, the expected range of anything, okay, over a given period of time. All right. So when we look at something like volatility, so if I pull up FCG, which is the First Trust ISD Revere Natural Gas Fund, and I see in November, I see a volatility of 45%. Okay, that is actually an annualized number. So with a vol of 45%, they are thinking that FCG in a given year will move about $7.65 up or down most of the time. That's a key word, most of the time. All right. So this is an annualized basis set to a specific period of time. So they're saying, if you look at this IV, this is Live All Pro, by the way. If you look at this IV, it's saying between now and the end of November, or excuse me, not the end of November, and November expiration, we're expecting FCG to move 45% on an annualized basis. All right? Which means it'll move 45% on an annualized basis most of the time. And when I say most of the time, that's 68.2% of the time. That's volatility. All right? Fear indicator. Don't ever call volatility a fear indicator. That is that's like saying because you buy auto insurance is a fear indicator. All right? Does anybody think buying auto insurance is a fear indicator? Does anybody here not? I mean, think about that. Options are really, in the end, a form of insurance. So, if you think that that volatility is a fear indicator, all right, what you're saying is insurance represents fear. Now, maybe on a blackjack table, when you see the dealer holding up an ace, maybe that insurance is a fear indicator. But it really is a fear. Volatility is a measure of, Alex Jacobson puts it, the cost of insurance. And that's really what it comes down to. Alex Jacobson Alex Jacobson, Katrina? He used to work for the ICE, actually, I believe, right?
Yes, actually, that's correct.
Yeah. He is a brilliant man, and one of the people that, he's one of kind of the fathers of the industry in a lot of ways, and he calls it cost of insurance, and I think that's an excellent description. All right. So he's with. All right. So a delta neutral trade is a bet on cost of insurance more than it is market direction. I think that's actually the way to really sum it up well. Is the cost of insurance that you're selling more than overpriced? Is the cost of insurance that you're buying underpriced? And we'll kind of play on volatility, right? He's betting that options have been mispriced. If a trader is buying vol, the trader thinks that options are underpriced. The cost of insurance is too cheap. Right? If the trader is selling volatility, right, the trader thinks that options are overpriced. Right? Now, what you're saying, Mark, we trade efficient markets. Options are perfectly priced all the time, blah, blah, blah. Oh, baloney. Options are almost never perfectly priced. They just aren't. And that has to do with the fact that we've got all these different, it's basically price discovery. Now, are they as crazy mispriced as they used to be? Probably not. That's a good thing for you guys. But are they mispriced in general? Yes. Oh, you are just the sweetest thing I've ever seen in my life. Thank you. Just made my day. My assistant just walked in and handed me the Diet Coke and made the day. What a great girl. So and actually 2 hard-boiled eggs. That's the thing is large trades, strange market reactions. Vol can get really overpriced, especially when we're in kind of panicky markets, kind of these weird, crazy markets. There are all sorts of things that can throw off volatility to the nth degree. There can be all kinds of mispricing. Okay? So, question, and here is, this makes it probably different from everybody else in the industry. All right? Is there an inherent edge in selling volatility? Who thinks there is an inherent edge in selling volatility? Raise your hand. Or who has heard this before? Let me know if you've heard this. Selling option premium, you're already a winner. Who's heard that before? There's 1, there's 2, there's 3. I've heard it lots. Yeah. It's baloney. It is absolute baloney. All right? It is the most, now, if you look at close volatility, which is the measure that they talk about, so the price change from close of market to the next close of the market, okay? In that scenario, implied volatility does trade at a premium. Now, raise your hand if you are the type of guy that can sell an option, close your eyes, and trade close. Right, I'm saying not if you include the highs and lows, right. Yes, but you have to live to the day. No, exactly. There's a calculation called average true range volatility. And it's a very important calculation. It's the one that I use to measure. It's the one a lot of people use to measure. All right? If you listen to the Vol Views podcast that I'm on, I was sitting talking to, this guy had possibly the coolest name ever. It was, he was actually a really nice guy. Normally I think these guys are kind of nimble-nosed, but he was really, really nice. His name was, Matt Strong, I want to say. Here we go. Oh, it was Chris Strong. His name was Chris Strong. I'm sorry, I like my name, Mark Sebastian. Great name. Great name. But who wouldn't want to be named Chris Strong? That's just an awesome name, isn't it? Now, I suppose if I was a girl, I wouldn't be as close. If I was a girl, I'd want Deborah Super Hot. That would be if I was a girl. But personally, what?
That's a great choice.
Deborah Super Hot. Yeah. Sorry. So anyway, the key is that average. He and I were talking about average true range yesterday, and average true range is such a better measure of volatility than kind of the close that a lot of people look at, and there's not the same edge in selling. If you take average true range into account, then the return on option is going to end up being the net of about the risk-free rate if you blindly sell, and it'll be the net negative of the risk-free rate if you blindly buy. Right, if options are efficiently priced. When options are efficiently priced. All right. So that average true range is really kind of a really important thing to look at. Right? So what I'm going to do, I'm going to literally tell you, hey, I think you can sell iron condors. I do. All right? But it's not this simple, close your eyes and sell that everybody out there wants to tell you. That is a load of hooey. Excuse me for cursing, Katrina. But I want you to know. All right? So that's, it's a hard sell, but it's the truth. All right. So now, types of delta neutral trades. We've got straddles, strangles, time spreads, butterflies, condors. We're going to look at a few examples. And I'm going to show you. Well, you can think or swim. Had a couple of requests for TD Ameritrade. I'm okay with that. We'll use, what do you think? You want to use FUM? Nice price. No. Why did I think they were doing that option? No. We'll use SDG again. That's a good one. All right. Now, a straddle. All right. Now, at onset. Okay. As I saw the straddle, I don't really have a lot of price movement. I mean, I guess I'm leaning a little bit. If we're priced right at $17, I definitely don't have any preference in price. But as we move one direction or the other, that's not true anymore. Take a look at this. If we're trading $18, would I rather the stock go up or down? Right. So, does that mean, does delta neutral mean that I never have a stock bias? No. But it does mean that at onset, I don't have a bias, one direction or the other. All right, now the next trade is called a strangle. And that would look something like this, a strangle. And the strangle is set up kind of a wide range. The straddle is set along one strike price. The strangle is set kind of a wider range. And again, does not have a price preference at onset. If we rally to $18 or fall to 16, you bet your blue horses I have an onset. By the way, if you have blue horses, don't bet them. Okay. I've never actually used that expression before. You bet your blue horse. I'm not sure that's actually a real expression.
We like it.
And thank you. I appreciate that, Katrina. So A strangle is, do I set strangles? Back in the day, I used to do a lot. Now I do a lot more kind of protective stuff like iron condors. Then you've got things like time spread. What's a time spread? That is where I might buy the November 17th and sell the Decembers. That is a short time spread. This is a delta neutral trade, but I actually want it to move. So if we run to 18, do I have a directional preference? What do you guys think? Yes, absolutely. I want it to go up this time. You can set up delta neutral trades where you want it to go up. Okay? And of course, you can also buy the time spread. Actually, that's a nice looking time spread. If I could get this done, I'd probably do it. Take a look here. Just going to go off on a little tangent, deciding whether I like this time spread or not. Well, vol could definitely go lower, but that's got a nice spread to it, so might be interesting. I'll play around with it. I need to look at it more. So, this is another type of this time I don't want to move. Butterflies and condors. I'll see butterflies and condors because we're going to get to condors. All right. So now, what is an iron condor? This is a combo of an out-of-the-money put spread and an out-of-the-money call spread combined to increase the total credit. Now, two things you will never hear somebody that is an option pit mentoring student say is debit spread and credit spread. Because there's no such thing. They are the exact same trade. Okay? There's call spreads, there's put spreads. A credit spread is a debit spread. A debit spread is a credit spread. A call spread is a put spread is a call spread. Right? It is an out-of-the-money put spread and an out-of-the-money call spread combined to increase total credit. Alright? The trader is guessing that the underlying will stay between the shorts until the trade is exited. So let me show you what an iron condor might look like in FCG. Just going to construct one in December. You might go to, you might look at something like the 2021 vertical. So that, time. Say that's 20 and say that's 15. Yeah, I can sell it for time. And then you might look at the 1413. Get something along those 15 cents. So here is an iron condor. So you can see here is the call spread. I sold a 1-point vertical, collected 10 cents. Sometimes you get a better price between selling put or buying call spread. That is absolutely correct, Ingram. Sometimes you do get that. All right. Sometimes you do, and that's the differentiating fact that they're basically they are the same spread. And if you get better on one or the other, you should do it. Right. So and then here is the put spread. All right. Let me show you why I would never call this why we wouldn't do credit spread versus debit spread. There's going to be a little bit of a tangent, but take a look at this. So here's the 1413 put spread. All right. Here's the 1413 call spread. Tell me, what is the risk differentials between these two trades? The answer is there is none. They are the same spread. One's a debit, one's a credit, but they are legitimately the same spread. All right. So there is your standard iron condor. Looks like a great trade. Okay, it's a beautiful looking iron condor. So let's talk about how and why, what my methodology is. Soaking out of the money call. Anyway. And soaking it in the money call. So that's just, anyway.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.